Southeast Radio's Business Matters with Karl Fitzpatrick.
Well, in an investment world which can be dominated by capital guaranteed bonds, crypto and shares, it can often be difficult to pinpoint the right investment. Dave Quinn from Investwise Financial Planning joins us now to decipher the plethora of investments which are available on the market today. Dave, start by providing us with an insight into your experience with JP Morgan.
Good morning, Karl. Yeah, so I came out of college in 1996. Seems like a long time ago now. And that was the time when the IFSC in Dublin was really taking hold. And I went working for fund administration companies, initially Deutsche Bank and then JP Morgan, in the IFSC, working on investment funds, mostly back and middle office, managing those funds from behind the scenes for 10 years or just under 10 years. Very exciting role in my 20s coming out of college. Felt like an exciting sector to be in. And I did learn a huge amount about how the investment markets work and how institutions invest money and, the flow of money during crisis. Especially there was a very big financial crisis in 1998, and we saw that upfront and personal, managing these investment funds and seeing investor behavior. So it was an exciting time to be working in the IFSC.
And how has that experience educated your own approach to advising clients on wealth management today?
I learned a lot about how people behave and how the institutions treat investors. Then quickly decided I didn't really want to be on that side of the table and wanted to be working with individuals personally on their own finance. And I brought those learnings to that advice to individuals, basically saying that while the institutions have big, huge brand names, JP Morgan, Goldman Sachs, all these big famous names from Wall Street, they don't actually add any value. They charge a lot of fees and they make a lot of noise about how good they are. But really, when it came down to it, we rarely beat the benchmark. And I noticed that, and I couldn't understand why the institutions weren't firing them and moving to someone else. But there's a lot of there's a real status quo in that side of the investment world. So when I started dealing with individuals, then I brought that knowledge and tried to educate individuals that paying more for investments doesn't get you a better outcome. Most of the time, it's much worse. And buying investments off these big, fancy investment houses only reduces your wealth, really, and improves their bottom line. And that was a big learning. And it's taken an awful long time to educate people that that's actually the case.
So what can people do to beat the market?
No one beats the market, Karl. That's the key. I'm in the business 25 years, and I've never seen it. Even Warren Buffett doesn't beat it. He just gets very close to matching it. So that there is that common misconception that an analyst and a great trading house can beat the market, but most of the time they've just been lucky over a short period of time and they market that story. But nobody, when you go out past 5 years of past performance, no one beats the market consistently. 95% of fund managers underperform the market, partly because they charge a lot of fees and partly because they make bad investment decisions. But as technology advances and the speed of information flow increases, it's becoming increasingly difficult to beat the market, particularly in the big markets like the US and Europe, where there's so much trading and so much information that no one really has much of an advantage. So it's pure luck.
I was listening to an interview recently with Jordan Belfort, the Wolf of Wall Street, and He said it's hard to beat investing in the S&P 500.
Yeah, and that's Warren Buffett's view as well. Is like in his will, he has declared the funds are to be invested in the Vanguard S&P 500 index fund, and that would be very much our view that unless you are a professional trader working 60 hours a week and particularly talented at what you do, it's almost certainly going to lead to poor performance picking your own stocks and investing your own portfolio. Or, I should also say, allowing an active investment fund manager or a stockbroker to do it for you. They're no better than an individual. And most of the time, you're much better off spending time worrying about your own personal finances and your business and your family and leaving the money invested in an index fund, as per Warren Buffett's advice. And who am I to go against his advice?
And I know from a financial planning perspective, you like to take a world view on this. You've just returned from a conference in Texas.
We went for a week to Austin and mostly to meet some really key progressive US financial planning firms, because the sector over there is about 10 years ahead of here. So we spent 4 days of the trip meeting US firms, sitting down with them, talking about what they do, how do they help clients, what can we learn from that, and what can we bring back to Ireland. And then the last 2 days were an investment conference with index fund provider called Dimensional, who are based in Austin, actually managed by an Irish guy from Dungarvan, interestingly enough. And they're similar to BlackRock or Vanguard. They're index fund manager, low cost index tracking, matching the market, and very, very good at what they do. And we wanted to meet them to see would we add them to our portfolios going forward. So it was a mix of some really good, interesting investment ideas from them and some exciting and kind of productive conversations with US firms who are shooting the lights out in terms of how they help their clients over there.
So how do they help their clients differently to what happens here in Ireland or indeed Europe?
Yeah, like most of Europe is the same except for the UK. The UK market would be similar to the US in that they've completely banned commissions and sales incentives for investment and pension products. So that means that the end user knows what they're paying for and, can demand a certain amount of service every year, same as you would with your accountant or your solicitor. So that's a kind of a fundamental difference between the US and here is the transparency of the relationship between a financial planner and a client. And because of that, because they're not getting paid for the products, they tend to start using cheap index funds who don't pay any commissions out. And that means the focus of the relationship shifts completely to financial planning, helping people achieve their dreams and help them, make the most out of their businesses and try and find that magical work-life balance. And at the end of the day, in simple terms, it just comes down to them helping people find out how much is enough, how much money is enough, how much time is enough. And that's a much more productive way to spend some time advising people than picking a fund or a stock or, moving people around between insurance companies or whatever the traditional broker relationship would be.
We've seen high inflation rates here in Ireland in recent years. How has that, along with rising business costs, impacted business owners' approach to financial planning?
It's a funny one, Karl, when you say that. While we would be encouraging people to take more account of inflation, I see a lot of business owners still sitting on a huge amount of cash in the company. And, as a business owner yourself, you'll know it's very important to keep a certain amount of working capital in place. But we see business owners with 3-4 times the working capital requirement sitting in the company, earning zero interest in a corporate bank account, even though they know from their own pricing and their own operations that inflation's running at still over 3%, I imagine. And yet they won't do anything with their cash for fear of taking too much risk or losing it.
And what advice do you have for clients in that position?
Firstly, you want to protect the business, make sure that you have enough cash flow that you need. But after that, then you need to optimize every penny. And there's a kind of a three-pronged approach to cash in a company. Do you take a little bit more salary? Because a lot of company directors don't pay themselves enough. When a company director comes into me, I ask them, what would the equivalent person, what would you have to pay someone to do your job? If you were to step aside and become the chairman of the business and hire a CEO, what would you have to pay them? It's typically double what they're paying themselves. So that's the first thing I'd say is, should you be paying yourself a little bit more and enjoying the fruits of your labor, even if that means paying a little bit more tax sometimes? It just can mean a better quality of life now rather than waiting until you're retired to enjoy that benefit. So that's the first point is, should you be paying yourself a little bit more? If not, do you need the money in the company, either current operations or for future retirement relief, entrepreneurs relief, kind of tax incentives and termination payments and those kind of things? Keep a bit for that. And then thirdly, if all else being equal and the cash is really burning a hole in your pocket in the company, it should be going into a pension and getting invested.
Just leading me on to the next question around pensions, because in some respects, is a pension not a tax deferral vehicle once you go over 500,000 euros in it? In other words, you get the first 200,000 tax-free, the next 300,000 at 20%. But after that, it's open season from a tax perspective. And what's your view on that?
I do hear that a lot. And if you were just to leave your pension in cash, that is absolutely true. In that you put some money in, you get 200,000 of it back out tax-free at retirement, and the rest of it you'll pay probably a slightly lower income tax rate in retirement than you would be paying now with the higher salary. But what people forget about, and this is a hugely important point in Ireland because we're taxed so heavily on investments, is that the investment growth is tax-free. So over a 20, 30-year period time frame of a pension contract, that compounding of dividends and rent and investment growth tax-free over that period makes for exponential gains that people don't value within a pension. If you take the money out as salary, okay, you miss out on the tax relief at the start, but then you're also going to be paying capital gains tax or fund exit tax on your gains constantly all the way through, which is destroying the compounding effect. So I know I would much prefer to have the funds sitting in a pension growing tax-free and pay some income tax on the way out, but have all that growth in the meantime untouched by the revenue.
And apart from investing the pension in, let's say, shares or funds, have you also seen clients invest in properties, rent those properties through the pension, and then get the flow of rent coming through the pension tax-free as well?
I have. It was popular pre-Celtic Tiger. That was very popular. Less so now, although I do see quite a push online from certain cohorts to encourage people to invest in property in their pension. But in my experience, it leads to worse outcomes than just investing in the stock market over the long term. The costs involved in buying a property in the pension are very high. It's very illiquid at retirement time, so you need to try and make sure the rental income generates enough cash that you get your tax-free lump sum, which can be a significant hassle for a lot of people. And you're invested in one single asset or two or three single assets in a single city, which isn't particularly diverse. And the timing can be terrible at retirement if there's a recession in that region. If you buy two or three apartments in the southeast, stick them in your pension, and the timing isn't right at retirement, it can lead to suboptimal outcomes, as they say. So we like to see diversification in people's pension accounts, but also the rental yield plus the capital appreciation on a property is about half the stock market return over the last 20 years.
Dave, is there much difference between what the product providers are offering?
There is huge differences, yeah. Like, to be honest, in a way, they're all very similar in that they'll have a bog standard type of index fund offering, and then they'll have their own internal, what they call multi-asset portfolios, which typically tie in with a risk questionnaire. So you'll meet your bank advisor or your broker. They'll do a risk questionnaire and you'll come out 3 out of 7 or 4 out of 7, and then they'll put you in the 3 or 4 out of 7 investment solution and leave you alone and move on. And there's no wider questions than that. And that's a very blunt instrument and doesn't really solve anybody's problems. But the big difference with the product providers really is their charging structure and what the financial advisor is getting for the advice, because that can vary from a pension account that is 0.3% per annum all the way up to 1.5% per annum, which is the difference between success and not being successful in a pension account. And almost all of that difference is broker commission and advice fees. So that's where the difference really comes in, rather than the product providers are somewhat generic, to be honest, and it's very competitive. They all watch each other very closely.
From an investment perspective, what are your clients currently looking at right now to invest in?
We see everything, Karl, from crypto to index funds, picking direct stocks. So there's a myriad of different issues. There's still a big propensity in Ireland to want to invest in property, although that's becoming less and less attractive, I think. We have 190 billion sitting on deposit in Ireland at the moment in cash, so we still love our cash and our property. We don't have a huge amount of people coming to us asking for index funds, maybe some younger savvy clients, but a lot of people are terrified of the stock market, so when they fill in a risk questionnaire, they'll almost always come out medium risk, medium to low. And it's our job as a financial planner sometimes to talk people into taking a bit more risk, because it's how they'll achieve their plans. But that's not always an easy conversation. And then on the other side, we get certain clients who want to pick stocks, meme stocks or crypto or something really, really high risk. We just explain the consequences and what the impact that might have on their financial plan if it goes wrong or right. We do get some younger clients really going for that to try and get rich quick. Maybe that's the only route they see to buying a house or getting on the property ladder or something like that. They take excess risk. And it's our job to educate people on how best to approach that. We don't always say don't do it, but we would just try and give them a steer on how do they balance that in other parts of their financial plan then, if that's the way they want to go. So we have some clients who are crazy high risk and some who are far too low on the risk scale. And it's our job to say, this is the risk you need to take for your plans to work out, not the answer to some risk questionnaire, which is a bit blind to the plan.
And Dave, finally, for anyone listening this morning that is planning to sell their business over the coming years, what should they be thinking about now and putting in place now?
Yes, okay. So I suppose they firstly need a financial planner or an accountant to give them a good steer on entrepreneurs relief and retirement relief, and maybe termination payments so that they get the maximum benefit tax-free from the sale. And after that, then what they need to decide is how much cash do they want themselves, personally after the transaction and paying capital gains tax on that sum. So they might decide, yes, I really would like to get X amount into my pocket so I can enjoy it and have some fun with the money. And if they are happy with that figure, then they need to decide, do I divert some cash that's in the company elsewhere into a pension or somewhere else so that it's tax deferred or they don't pay income tax and capital gains tax on it. Now, some of these business exits will have a holding company, which is great for at least taking some control over where the cash goes on exit, especially if someone is looking, if it's an entrepreneur who's looking to reinvest back into more businesses. The holding company structure is fantastic for that. But it doesn't work particularly well for someone who just wants to get some cash and enjoy life with the money, lotto win type plans. So we try and talk through exactly what people want after they sell. Are they going back into business? Or are they at retirement and they're happy to enjoy the money? And how much do they want? And how much can we divert elsewhere to keep the tax bill to the minimum possible? Because you can get $1 million out under entrepreneurs relief at 10%, or 750,000 out tax-free. They're the kind of typical limits for the tax-free amounts. And after that, then there's structures need to be put in place for what happens with the rest if they're lucky enough to have a business that's worth more than $1 million.
Well, if you've just tuned in, that was Dave Quinn from Investwise Financial Planning. And I'd like to thank Dave for sharing these important insights with us this morning.
Southeast Radio's Business Matters with Karl Fitzpatrick.